Today on the show, we're talking your investing Qs. We'll provide some As. And today I'm joined by Owen Raskewicz. Is that how I pronounce it?
Perfect. That's actually really well done.
Well, you're welcome. We are recording from Owen's studio. Owen has the Australian Finance Podcast. And we'll talk about you a little bit later. But Anonymous asks, how do you know what to invest in without losing $, sign? It still feels risky.
Well, I think the first thing is to know why you're investing would be a good step, because I think the definition of investing is that it's risky. If it doesn't have risk, then I would classify that as savings.
What about, like, to a non, I would probably say it feels risky. Risks can be lowered with experience and information. I'm not opposed to a crap analogy. A lot of the time, like if you're flying and there's turbulence and it's bad, you're like, oh, this is scary. Oh my gosh, this is risky. Where on the flight deck, the captains are probably like with their cup of tea during the same amount of turbulence. Oh, so how's that backhand slice going with you lately? Like it's a business as usual for them.
Absolutely.
How do you tell your listeners to get comfortable with taking risks?
I think what you're talking about there is just like the knowledge gap. And so I think one of the things that happens with investing in particular is that it's unpredictable in the short term, and the longer term it seems more predictable. Like it's not like a perfect, replica of what happened in the past is going to happen in the future. But what we do tend to see is history doesn't repeat, it rhymes. And so you kind of get a feel for it. It's like, you get a feel for when you go to the gym, what it should feel like and what it shouldn't, like what's an injury and what's not. And I think for investing, it's much the same. You kind of just get a feel for it. The way I think about it and investing writ large is that it's an apprenticeship. It's not a degree. And I think this is important for people to understand, is because in an apprenticeship, you learn by doing. In a degree, you learn the theory most of the time. There's some applied learning, some free labor out there for sure through these uni courses. But for the most part, it's a thing that you learn by doing. And I think the longer you do it, the more you will realize that these types of things happen. You don't know exactly what comes next, but you have a feel for it. And there's a famous saying that stock markets climb a wall of worry. There's always something to worry about, but the stock market has somehow kept going up. So it's climbed up this giant wall of worry.
Yeah, I like to say walking a yo-yo up a hill.
Yeah, perfect. Yeah. The other one is like a random walk with the dog on a leash. It's kind of going all the different directions, but you kind of know where you're going.
But Anonymous, what I would do is I would open a micro investing account, whatever an app is, like what do we got? Shares is a superhero, a Beta Shares Direct,
Raise,
just some fractional. Look at even VAS, Vanguard Australian Share Fund.
Yep.
Understand that that's 300 of the top Australian companies. Throw 50 or $100 in there. Just see how it feels. Like, this is not an all or nothing thing. Let's walk into the water.
Do you remember paper trading?
Yes.
So this is like before we had these types of platforms that you just mentioned.
Like the ASX stock game.
Yeah, kind of like that. But even before the internet, believe it or not, that was the time.
No, I'm not that old, Owen.
But when I remembered growing up and thinking about this sort of stuff, you used to get like the AFR or any of the big business papers, and in there they'd have all the stock prices and stuff.
Oh, yes.
And grandparents, to simulate what investing was like, is they would effectively say to the kids, all right, you get, 5,000 fake dollars, and we're going to track the prices.
Wow.
Just on paper, we're just going to track it. And this is before you could have like a demo account and all that. But because these platforms now, all the ones you just mentioned, it's so easy to get started. You don't need to do any of that anymore.
I should have bloody sold this episode to a sponsor and be like, put a code in the thing, use the code M3 and get $10.
You could still do it.
I'll still do it. I'll put it in post, everyone.
There'll be something
I'll try and sell, at least throw $10 in.
Yeah.
So there you go. Well, just get started. That's what we say. Today on the show, joined by Owen Raskewicz. Tell us a little bit about what your day looks like.
Days are pretty busy. We've got the podcast, obviously, but most of the time now it's dealing with financial advice clients and dealing with investments. So we kind of split the middle in terms of where we sit in the ecosystem. So we can help people invest. and you can just invest with us on our website, or you can get financial advice through us.
Yeah.
It doesn't actually make a difference whether you're a financial advice client or a direct, like on the investment platform that we have. You get the same portfolio. The only way the difference is the fees that you pay.
Yeah.
So if you just take it off the shelf, you pay a percentage. And if you come to us financial advice, it's fixed fee.
Yeah.
That's the only difference.
So the Rask Invest is actually everyone, it's very similar to Vince's Light Sherpa Invest.
It's similar.
You've got your own portfolios.
Yeah, Vince's minimums would be lower.
Right.
So Vince's slightly different model, but it's very similar in what you're getting from someone is very similar.
Yeah.
We're HIN based. I think that's custodial.
Yes.
So the fees can be lower over there.
Yeah.
Versus ours can be higher. So that's probably the big difference.
It's funny. We're going to get to it later in the show around this outsourcing your investing because we don't want to outsource our brain or our vibe, but we can outsource our investing. But we're going to get into it right now. This episode is brought to you by Sphere Home Loans. We, at The Money Show, we are pro mortgage broker, and you need to know one thing when it comes to getting your first home, your next home, another home, if you want to refinance, hell, if you want to cash out and buy a yacht with 300 grand, knock yourself out. It's an option, not saying it's advice or the best advice, but Sphere Home Loans, they help our listeners all over Australia. We are pro mortgage broker here on the show. Thank you to Sphere Home Loans for helping us bring the show to you. My name is Glen James, joined by Owen Raszkiewicz. Is that
Polish?
Polish. I've asked you that before.
Yeah.
I've got a friend, she's Polish, and she sends the Polish flag emoticon. And I always write, how's Indonesia flag going? Anyway,
Upside down.
There you go. Anyway, my name is Glen James, joined with Owen. We're talking about investing. Let's do a show right now. Before we get into it, this show is general advice only. I've got a license to provide that advice. Full details can be found in the show description. My name's Glen James, former financial advisor. I hosted this show and a show called Retire Right. I've got some books, the award-winning Quick Start Guide to Investing and the Quick Start Guide to Your First Property, available where good books are sold or in the description. If you're new here, welcome. If you're an old hand, welcome to M3. Let's get into it right now. All right, here's another banger. I have ETFs and individual shares. The shares are up 80% from when I bought them. Is it wise to sell them down and buy ETFs while it's good, or keep going? It's a gold mining company, FYI. Well, over to you.
Well, thank you for that one. Shirley, great question. The difference between ETF investing and share investing should be talked about, which is that when you buy an ETF, you obviously get a basket of shares. Individual companies are entirely dependent on the two things. One is the performance of the company itself, and the other thing that they're dependent on is what other people think of the company itself. So in effect, what that means is you can have a good gold mining company and its share price can go down. You can have a good gold mining company, and its share price goes up. You need to understand how those two are interacting. With a gold mining company, I'm just going to be general here because I don't know what it is. They can sometimes be quite speculative. And so you've got to be prepared that it may be up 80%, and then in 6 months it might be down 20%. That's just the reality. The only way to know is to stretch the time horizon and be like, what is the performance of this company through time, and do I think it's going to keep being good? That's why you pay people to do that, and even they don't get it right all the time. So I would just in general say that for folks that don't know the absolute intricacies of the companies that they own, ETFs are so much safer for the extra kind of they're just so much easier and safer compared to an individual company.
My question to Shirley would be, are you an investor who's building wealth for the long term, Shirley, or are you a speculator? Looking at the moment, I think it is less about building wealth, because when we build wealth, well, this is me, I literally my reason for living financially is to give some, save some, and spend some. The save some is for the Glen of tomorrow, whether that's for a new lounge or old Glen who can't work. I'm just shoveling money into an investment provider solution. So my question to Shirley is, what are you doing? Like, absolutely. It's up 80%. You're allowed to take some chips off the table.
Yeah, absolutely. The thing is, you're basically saying, like, why are you doing it? And I find a lot of people that own individual shares are attracted to it for the excitement.
Yeah.
The potential for gains.
Well, we only do it for the potential of gains, don't we?
Some people, I would say, like from me personally, is I actually just enjoy learning about companies. So there was a time when I was 100% invested in shares, no ETFs. Now it's majority ETFs, less shares. And the big thing that I realize is that I can have my cake and eat it too. As in, I can have the excitement and this, this shiny gold company over here, but chances are I might be wrong about that. So don't bet, future Shirley on being potentially wrong, because there's a good chance of that. Like future Shirley's money's over here in ETFs and stable and this sort of stuff. But the fun Shirley's over here and is having a little bit of a play around with these gold companies, which is fine. It's just knowing the purpose.
Okay, gun to your head, Owen. We'll make it up. Shirley's got VDHG, for example, with $2,000 in it, and a gold company that's now worth $8,000. So she's got a $10,000 pot. What are you doing if you're that?
Piling more into VDHG. I would sell the majority of the gold company. I would have 80%. I'd have it the other way around, 80% in VDHG.
Yeah, I would probably use this time, Shirley, as a flashpoint to set some portfolio rules in your life. And I talked about this in the Quick Start Guide to Investing. Have some type of investment constitution that you use. And that could be, based on my portfolio, I'm only having 10 or a maximum of 20% in stuff that is individual speculative. So I'm probably, I oscillate. I generally don't. I'm holding an individual share at the moment.
Are we allowed to know what it is?
Yeah, it's Macquarie Bank.
Oh, okay.
At times in life when you hear the when dickheads do tariffs and Liberation Day stuff and things really tank, you often hear a beeping noise in my world, and that's the truck backing up. And then only it's a very minor part of my net worth. But I've got some rule where it's like I don't have 100% of my net worth in Macquarie. And I think it might only be up like 25%. So I probably need to take some off the table.
I feel like Macquarie.
Actually, I need to ask you, is it a hold?
This gold?
No, my friggin' Macquarie shares. What are we recording this in June?
Well, I think that over the ultra long term, so 10 to 20 years, I think Macquarie is one of the best companies in Australia.
Yeah, I love it.
I just think so there's speculative, which is what potentially this gold mining company is, and then there's Macquarie Group, and the difference is, like I said before, share prices go up and down for two reasons: the company performance, but also what others are willing to pay for it. Macquarie will go up and down because of what it does.
Yeah,
but the business itself is easily one of the best businesses Australia has ever produced. And as long as that continues to be the case, it can oscillate up and down, but over time it's going to keep compounding. It's one of those companies that if it ever goes on sales, you would just buy it.
Yeah, and that's kind of what I did, because I don't follow direct shares heaps. I've got a couple of the big dogs that out of personal interest.
Yeah.
And Macquarie's one of them. And when it went on sale in a big way, because I literally DCA every week, an amount goes over to my portfolio from my bank account.
Yep.
But I'm like Shirley. It's like, I want to be investing. And there's been times throughout the years where I haven't had individual shares. So it's
Question for you. You own Macquarie.
Yeah. Gosh, I'm scared.
Do you then bank with Macquarie?
The business does, yeah.
Because I feel like this is a big endowment bias effect, is when you own shares of something, you look more favorably upon it.
Totally. But that's not it's good and bad.
Oh, it's good and bad because Macquarie's both a great bank and a good
Put
company.
it this way, everyone. The minute ANZ turn around and give me interest bearing at a good rate on my business money, I'll come back to you.
Yeah, fair enough. Yeah. Or
But can you
CBA no account keeping fees for no stupid reason.
that's what I mean. Like, why would I have my float of business savings not on a Macquarie CMA?
Yeah.
Is there a better solution for a business?
I probably haven't come across it, to be honest.
So,
and that's why Macquarie keeps doing so well.
Yeah.
It's figured that stuff out. So.
Yeah. Anyway, there you go, Shirley, and a bit of commentary of old Glenny boy. But that's not everyone go and buy Macquarie because you probably missed the boat right now. But
it's just interesting.
I think it was well under 200 when I bought it. So
it would have been. Yeah.
Okay, back to Anonymous. My son is 17-year-old second-year apprentice plumber. Safe job. AI ain't coming for him.
Mm-hmm.
He's been buying NDQ and VAS monthly for 18 months. Now has approximately 20K worth. Awesome. The question is, if the proposed changes go ahead, is it still the best strategy? Goal was to buy an investment property when possible. However, the new taxes would take a big chunk out of his deposit when selling. Not necessarily. That's my editorial comment. After some general advice, please, in the best strategy moving forward. All right. We've got a 17-year-old plum dog who wants to buy an investment property one day, and he's clearly saving for that with his NDQ and VAS.
Isn't that awesome though? 17 years old, yeah.
Far out.
So good.
Wish I had 20 grand at 17.
What's that saying? You show me the boy at 7, I'll give you the man. I feel like
I'm waiting for the Glen man myself.
I feel like you show me the son at 17 and I'll tell you what the man looks like. I feel like, or I tell you what the retiree looks like. I tell you, your son
covered from toe to neck in shat being a plumber.
Well, that's it. But I tell you what,
yeah.
Without knowing anything else, and obviously strictly in the realms of general, as we heard, I feel like this young man will retire wealthy.
Yeah.
I have a very strong sense of this, like staring into my crystal ball, because they're doing all the right things, and there's clearly a parent around that's got a head on their shoulders as well. I guess the question is like, I agree with you with that tax comment. That's like a very small tail on the end of a very important bigger dog that's not going to wag the other way around.
Yeah, so for full disclosure, everyone, this episode's airing on the 30th of June. I am a little bit early at the moment with episodes. We are recording it on the 10th of June. At the moment, the proposed tax changes have been obviously waved through the lower house. We don't know what's going to happen. We'll answer this on the assumption that it will be baked in as is. I mean, yeah, what do you reckon? It's just hold the line. Like, what are we doing here? We're not.
Yeah, I think this is a good opportunity to introduce a principle called what I call the best expression. You probably have a different name for it, but once you know what the North Star is, in this case, it's property. You talk about this in your book, actually. Here it is.
Oh, yes.
Yeah, the Quick Start Guide to Your First Property. Once you know what your North Star is, you can easily reverse engineer to what is the best strategy to get me there. And we know that it's property, right? But they've said in this that it's an investment property. Does it have to be an investment property? Could it be a place to live in if he's a plumber and he's quite...
Could it be a plumbing business?
It could be anything, right? Like it could be... It's really interesting here. So if I'm going back to best expression, first principles, so to speak, I'm thinking, what is the best strategy that gets the young man into what he wants? The best expression of this could be that we don't even think about this. We go straight to the first home super saver scheme in a little while, because a plumber, apprentice, still earning pretty good money, probably over the tax threshold. So there's probably other things. Like we've got our blinkers on. We're focusing on VAS and NDQ, which is great, by the way. But maybe there's a different lane over here that we've missed because we're just focusing on this. I would say that it doesn't really change. If the momentum is there, he's really keen on it. These two ETFs are best in class. They're the A++ of Australian ETFs. They do two different things. NDQ is the US stock market. VAS is the Australian stock market.
NDQ is more the tech side, the NASDAQ, yeah?
Yeah, NASDAQ 100. So you get Apple,
that's going to
Google.
be a bit volatile.
Yeah, it'd be a bit more volatile. Under the surface, however, Glenn, the thing to keep in mind is that the companies in the NASDAQ 100 have tended to grow their profits faster than many of the other markets. That is why over the 10-year stretch, I think profits as a whole of the whole NASDAQ 100 have grown at over 20% per annum.
I don't expect to know this off the top of your head what the dividend yield is. Is it like 2%? Or?
I'm pretty sure it's under 1% for the NASDAQ 100. For the S&P 500, it's 1.5.
Yeah, because this is, if you want a side quest.
Yeah, I know what you're about to say. Yeah.
Well, potentially, yeah. You know what I'm about to say in terms of income versus growth, potentially. But I'm at the moment looking to invest for my nephews. So I set up a BetaShares direct account in my name, and I told them I'll do it, but you got to get your own tax file number because we want to do it correct. So many people don't do this right.
Yes.
We know that there's a punitive amount of tax for minors over $416. I think my strategy for the boys, because they're 14, is literally go for growth, not yield, because the account can grow with less income. They'll be able to save more money without getting. So in my mind, I'm like, okay, if we save 10 grand and it was 4% interest, your 10 grand is done with paying over income tax on the $400. Okay, so if it was a little bit more growth, it might get us to 7 grand capital-ish. But I'm thinking I either load them up and do a IVV or NDQ or something like that, so they can have more capital invested between now and when they're 18.
Yeah. So we have a kids strategy, and inside it is only 2 ETFs.
Oh, what have you got?
We've got IVV and we've got VAS. But you could easily sub out IVV and just have NDQ and VAS, because I think what you're talking about is exactly what I was thinking when I put this together was, so the punitive tax, the harsh tax that comes for minor accounts is when the kids start earning more than $416 or whatever it is.
Yeah.
Right? Realistically, just so people are familiar, people are really spooked by this. What happens after that is you get taxed at like 66% until about
$1,400.
Yeah, until you get to whatever.
Yeah.
But all that does is that just aligns the kids' account with the highest income tax. So realistically, tax is bad, air quotes, but it's just the reality. Like you earn money, you pay tax. It is what it is. So the only way to really massage it would be to say, we're going to try and aim for less income and get more growth, right? So these ETFs, the reason why these US ETFs make sense is because they're paying less dividends.
That's right.
So they can compound faster. I was just looking at the BetaShares website right now. The fund itself, past performance is not always indicative of future performance.
That's an interesting tell, though.
It is. But so over 10 years at the date of recording, 10 years, NASDAQ ETF has compounded at 21.3% per annum, which is like, you're thinking about tax. You don't even need to worry about tax when you're getting that type of stuff.
This is the problem, kids. That ain't normal.
No, it's not.
So
throughout history, that's not normal.
Yeah. So anyway, I think in answer to Anon's question, just keep on keeping on. Like we're not, the political discussion aside, we're still not paying tax on inflation, which is what the main issue was when they introduced this 50% discount. That was one of their reasons for introducing that, to strip out inflation in an easy way. But yeah, you're still going to get taxed on your growth.
You know, Charlie Munger has a great saying, or the late Charlie Munger, he had a great saying. He said that compounding is very powerful, don't interrupt it. And compounding in this sense could mean, the annual returns or whatever you're thinking about. But it could also mean the habit. It sounds like this young man has an incredible savings habit.
Totally.
An investing habit. Don't interrupt it.
No. I would say to this young man, apprentice promise of his second year, we've probably got 2 or 3 years before he wants to buy a property anyway. There is a portion of me where it's like, if that's your goal, maybe we need to just slow down. We don't know when he wants to buy the investment property.
Yeah, it could be 5 years, could be after Europe, could be before Europe, could be no Europe, whatever.
Yeah, I'm probably just keeping the course.
Yeah. And the thing is, that's where as he starts to earn more, if he's still living at home with mum or dad or both here, you can start to explore the other options like the first home super saver scheme.
Parental guarantees.
Yeah.
Use a parental guarantee for an investment property. Get this kid in a property the day he turns 18. If his income's good. I had a crap income as an apprentice, but it's not 1912 anymore. But like, can we get this freaking kid into a property ASAP?
Yeah.
Help the guy out. Then I want him to be the best plumber ever, and even being better than a plumber, being the best business owner ever. Okay, following on ish from that last question, Benjamin asks, thoughts on a super simple portfolio for long-term growth, 20 plus years, 90% IVV, 10% gold ETF. Looking forward to your thoughts. Long-time listener and a fan. I said to everyone that you were coming on the show, so he's a long-term listener.
Did you really?
I did.
Oh, that's very kind of you. Thank you, Ben.
What do you? Can I spit out my thoughts on the table first?
Absolutely. It's your show.
It's our show today.
Okay.
I'm still a big believer. People are like, I want to invest 20 plus years. I'm like, let's just turn up super. And then if you still want to retire early at age 55, in the 10 years, 5 years before, maybe just accrue cash as a bit of a bridge. I don't know. I'm bullish on super because of the tax advantage nature of the environment, both getting money in and also the growth.
Yeah. I agree generally. I also push back a little bit and say, and you said this when we spoke recently, was there's current Glen and future Glen, or there's current Ben and future Ben. And so you can do a bit of everything. Like it's not binary, right?
Yeah.
This portfolio is actually quite interesting.
Yeah, I want to double click on that with you.
Yeah, so there's a pretty famous AFL footballer named Chris Judd.
Right.
I don't know if you've ever heard of him. Played for West Coast and then Carlton. And he now became a fund manager. And when I interviewed Chris, when he was just fresh days becoming a fund manager, he came in onto the show and he told me that his strategy was in effect maximum growth on one side and then maximum gold on the other side. This is what we call a barbell because it's kind of like shaped like a barbell at the gym. You've got like a big amount of your portfolio on one side and a big amount on the other. Rather than like an even pie chart, you've kind of just got two extremes. The idea is that if stocks go up, maybe gold doesn't do as well. But if stocks fall, you've got some gold to give you protection. Pretty simple idea. And it's called a barbell strategy. What I'm seeing nowadays is actually people going to another extreme and being like, it's not just gold, it's all of these commodities. It's copper, it's silver, it's lithium, it's all these other things plus technology. I have always been a fan, Glenn, of just having simple portfolios. Like this is simple, but what I mean by simple is like just an even spread of everything. I feel like some Aussie, some US, some global, some gold, some bonds. I just like simple.
Yeah, I'm personally not a 100% growth investor.
Oh, me neither.
And again, it's the Dunning-Kruger effect haunting me. But what I would say is to Ben, like I love IVV. Like it's awesome.
Yeah, it's great.
I love gold. It's awesome.
Yeah.
But I also, where is our infrastructure? Where is our property exposure? Do we want a portfolio of a variety of assets? Well, Ben doesn't. He just wants US 500 and gold. The thing is, you live by the sword, you die by the sword. In 20 years, Ben could have the best experience in the world. Love it. He could also have the worst experience in the world in 20 years if drawdown comes. Like, I'm sure he'll do fine because if we're living on less than we earn and investing the rest into growth assets, you're going to be fine if you leave it long enough and keep your mitts off it.
It's interesting. I've got two interesting stats to throw at people. One is that if you invested in 2000, which peak.com, it would have taken you about 13 years to see a positive return, just in capital growth. You would have got some income over the years, but just to return to the point at which you were 13 years earlier. That's in the US stock market. US stock market, like everyone, it's the greatest, but that's the reality. The other thing is, if we look at the UK stock market, over about 20, 25 years now, I've just gone off the top of my head, the UK stock market has returned. Actually, what do you think it's returned?
Oh, gosh. The FTSE?
UK. Yeah, FTSE.
Oh, I wouldn't even know. How long?
20 years.
So the US did how much over 20 years? 20?
It's probably done about just under 20. It's probably 15.
Yeah. I don't know. 7.
Something like 5.5.
5. Yeah.
That's pre-tax.
Yeah.
That's pre-inflation, right? So imagine if you were like, the year is 2000. Let's go back in time. This is the British century. We've just done this amazing thing. Yeah, America's this force. But you're thinking, it can't be that bad. I've just piled all my money into what they in the UK called trackers. They call them index trackers. We call them index funds.
Yeah.
They've just piled all their money into the FTSE 100, low cost. Lo and behold, it's 2026 and they've got a 5.5% return, paid tax on it, got inflation in there, and they've gone, holy heck, what's just happened? So to your point, I have no idea if that's going to be the case for IVV, but we hold IVV for disclosure and gold. So the range of outcomes is what Glen was referring to before. If you have a diversified portfolio, you can never do worse than your worst and you can never do better than the best individual investment. But if you've only got 2 positions or 1 position, you're just beholden to that. And so what I prefer to say is don't prepare for a certain future, just prepare for any future. Just have something that will always be, reliable. And so a bit of US, bit of global, bit of everything. I think that's great. And we're entering the Chinese century, don't forget.
Yeah, okay, Kevin Rudd. I don't know. The older I get, I'm just like, I'm crap at investing. So I literally put a weekly amount into a managed portfolio.
Yeah.
And because I want portfolio-based rules. Now, whether that's VDHG, DHHF, we know that there's rules. There will be rebalancing. I don't get my mitts off it. It just does all the work.
Yep.
Back to Shirley's question, the rules are there. So, no, we're selling the winner. We're not going to have this winning bias and, we have to, I believe, outsource our investing to a rules-based portfolio if you want to build wealth for the future, because it's going to give you the smoothest ride and probably the better outcome.
The thing is with the rules, right? The rules have the reason you have them, they're like guardrails. You have good and bad outcomes from them, but at least they're predictable. The problem with people that have no strategy at all is that they may be great investors, but the moment something bad happens, and it happens inevitably, we talked about the wall of worry, there's always something. The moment that happens, you are just a fish out of water. You have no idea. You're just flapping around thinking, do I sell gold? Do I buy more IVV? Maybe I got it wrong with IVV. Maybe I should have gone IHVV because of the currency. That was last year, by the way. So like, just have some rules. Know why you have those rules. Write them down. You can change them in the future, but if you don't write them down, you're just going to be a fish out of water.
Yeah, and that's it. If Ben wants to live by this, awesome. But just know, Ben, in 20 years' time, if you do a back test and it's 8% a year worse off or whatever that is, well, don't whinge. You could have had a portfolio with a bit of everything.
Yeah. And like we're speaking generally here, of course, Ben, but one of the other things that you might want to just look at is IHVV, which is exactly the same ETF, just with currency hedging.
Yeah. So do you hold the hedges what's your rationale?
So for that period that I mentioned before, from the 2000s to 2013, once again, it's if you take the philosophy is don't prepare for a given future, prepare for any. Between the year 2010 and 2025, say, we just became used to this slowly gliding down currency, which then meant that all of the shares that people had in the United States was worth more at the same time that they were growing really well because there was a lot of like pro-government support for big tech and stuff. But if we take those two ideas, like falling currency, pro-government support, we're now in this kind of multipolar world. admittedly, like it's a bit flaky, but let's say we are. Australia's kind of been through a few trade wars already over the last little while. The currency might not be as predictable. And we've also been in this glorious time of the United States stock market, which may not necessarily, it could, I suspect it will, but it may not necessarily bear the same fruit. So I just think, why not have a little bit hedged? I speak a lot with the beta shares guys, and their philosophy at the time when I spoke with them was effectively like about 1/3 of their core portfolio is hedged. For us, it's about that as well. So for every $4, we put 3 into IVV and 1 into IHVV.
Yeah.
It doesn't. There's no, like most financial advisors, as far as I know, where I just go half and half.
Yeah.
I don't think.
I never really did it because all the data I was looking at over a period of time, you pay a little bit more in fees, and the wash up return, it was hardly there anyway.
Yeah.
And I don't mind having currency as part of the diversification.
Yeah, because it actually is a diversifier if you think about it. Some people see it as risk, some people see it as diversifier.
So anyway.
The problem with our industry on this, Glenn, is that a lot of the literature for currency hedging is not written for individual investors. In fact, there's really none. The literature is written for institutional type investors. And
probably not based in a commodity town like Australia.
Yeah, it's the United States and Britain, basically. But the reality is most of the literature on whether or not to currency hedge is based on pension payments.
Yeah.
So meeting a pension obligation, if you're Australian super, is really important. You can't afford the fluctuations. But if you're an individual investor, stretch the time out. Like you said, currency might actually be a good thing.
Yeah. Anyway, there you go, Ben. Do what you want. Don't care.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
Anon says, love the show. I have 20 ETFs in my play portfolio. How many ETFs is too many? I'm okay with my limited overlap and I'm okay with my large tech focus. I have my core, dividend and tech favorites I DCA into monthly. When I rebalance in October, should I take the knife and be brutal? Love to hear a professional view or professional views.
Okay. You want me to go first?
You're the professional. I'm just the dickhead with the microphone over here.
Okay. So now they say play portfolio here, which is great because it highlights to us that this person is being sensible, as in they maybe are aware that they're not taking themselves too seriously. So for me personally, I think you start to get up to 20 ETFs, it starts to become unwieldy. That said, if it is just the play portfolio and you've got your main money somewhere else, and you can just have a bit of fun and learn and grow and do all those types of things. I think that one of the things that's somewhat apparent in our community is that when you invest, there's two types of people. There's a DCA, I just pay the bill, investing bill, and it's done. And then there's the other side of the community who are just super curious that are like, oh, I love what hack the cybersecurity ETF is doing. I love the companies. I want to learn more about them. On my way to work, I listen to an analyst call rather than Netflix. That's just who I am. If I'm talking to that really deeply financially curious person, I say to them, have as many as you want if it's sensible and it's quarantined. But if you're the first person, that doesn't make sense because that could end up in a lot of inappropriate types of investment decisions and those types of things. So just know who you are. The other thing that I'd probably say is that some of the simplest portfolios are often the best, for the side effect being that when there's a crisis, you're comfortable. When there's a crisis and you don't know why you have 15 ETFs, like maybe potentially this person, you're more likely to make a mistake. That's what I've found.
Yeah, I would just go back to the play portfolio. Just make sure that it's no more than 10% of your equity portfolio.
Yeah.
And do what you want. Literally do what you want. I would say we're not doing this with a direct broker with a HIN and all that BS. You'd want that on custody because what a nightmare if you've got 20 ETFs in your play portfolio.
Yeah, it's going to be a lot of brokerage.
Yeah, but even the tax reporting.
Yeah.
Like, what are we doing here? So, yeah, I don't know. Every time I get any questions like this, no one is beating the market long term. So what are we doing here? If you want excitement, go learn a hobby. Go to the casino. Like, are you building wealth for the future? If you are, pick a portfolio and just focus on shoveling money into it. Keep your friggin' mitts off it.
Yeah.
And if you want to carve out 10% to play, well, do what you want, knowing that it's a I'm interested thing.
Yeah, there's a probably intellectual edge or intellectual curiosity that they want here, potentially. So you mentioned like not outperforming the market and that sort of a thing. I think if you are approaching it from the perspective of I think this is actually something that I'm good at and et cetera, the number one thing to do if you are that way inclined, and that's your thought process, like I want to see if I'm good at this thing called investing, is you must track yourself. You must find a way. Either you do it in a spreadsheet and you do it properly, or you use a tool like ShareSite or Navexa or one of these automated tools that actually give you true reporting. Because if you're not that good at it, go and find something else to do.
And if you think you're that good at it, well, prove it. Go get a job and be a freaking active fund manager and beat a main benchmark. Go on.
Yeah. There are some tools out there that you can use if you're interested in this sort of stuff. The most... Well, it's a bit more niche, but Strawman, so strawman.com I think is the URL. That's effectively where you can go and set up an account and you can have like a play portfolio and it actually tracks your returns and it's like really honest. But the reality is most people aren't that way inclined. So that's probably not them.
I would rather, me personally, if I had the time, I would like to, but I just don't have the time.
Yeah.
With that play portfolio, right? And this could be controversial. So if I had $100,000 portfolio and $10,000 at all time was earmarked to play, what are we dicking around with ETFs for? Let's learn how we do options trading. Let's do that with our time because that's going to be more stimulating. You might make some money from it. I think that's a better use of my research time.
Yeah, well, this is just a general thought for life. But you want to put your energy into something where you get the maximum leverage for the thing that you're good at. And if you are good at investing, find the area of investing that you are very good at and see if you can benefit from it.
Yeah.
I think that's a really important point.
And while I'm ripping, I have a bit of fun more when it's an anonymous thing.
Yeah.
Like, I love everyone who listens, but also I'm making entertainment. Why are we having 20 ETFs in a play portfolio? Get some friggin' direct shares and have a crack, you dog. Nah, love you. Anonymous said, I've been getting a little confused lately as I was under the impression if you had a portfolio of only a couple of ETFs, you could almost set and forget, balancing occasionally. As in, boring but effective. However, in the last couple of What Would Glen Do episodes, it seems as though this isn't the best system for wealth creation. What is the best system for an ETF portfolio? So I think my whole shtick there was people saying, he's one guy who was like, I've got $400,000 of like 2 or 3 ETFs. And I'm like, well, your portfolio sucks because you've got bugger all diversification. It's not rules-based, blah, blah, blah. This is why I'm a big advocate for actual robo-advice portfolio solutions.
Yeah.
Be it Rask Invest. Yeah. Someone else actually wrote a question. They're like, I've been using StockSpot for the last 10 years. Roast me. I'm like, sounds like a pretty good scenario.
Yeah, StockSpot have done incredibly well. So Chris and the team, shout out.
Chris has been on the show. Like, I'm not roasting you because you're really smart, because you're like, I'm going to focus on living and earning and doing my investing with
Just shovel it in there
with a portfolio.
Let them do with it.
Oh, but you got to pay like fees.
That's the thing.
Yeah, but guess what? The behavioral thing that isn't going to get in your way, and this is the problem. When people are like, I don't want to pay like a 0.4 or something.
0.5.
0.5 with you, is it?
Yeah.
I don't want to pay 0.5. I'll do better. Yeah. All this stuff. They won't, like sequencing risk, you won't see the negative impact of your own actions unless you're tracking it.
Yeah. So this is actually a really interesting thing, right? Like you've been doing the podcast for a while, and before that, financial advice and that sort of a thing. I feel like we've got to a point in the general consciousness of people that yes, fees are important, but I think the pendulum has swung a little bit back the other way, where it's yes, they're important, but there's probably other things that are more important, like your behavior, the type of investor you are, and how you understand yourself. Like these things are probably more important. And if you just take a look at like Chris's portfolio at StockSpot, done exceptionally well. They've had a lot of gold, which has been a superpower for them, but exceptional returns. Would I have taken, now we've got hindsight, it could have gone the other way, but would I have gone back 10 years, given Chris my money and done that? Yeah, I would have, right? It's great, right? So I don't think that there's necessarily a right or wrong way to approach this, but I think there's a big behavioral element here, which is that if you're going to sell at the wrong time, it's going to be way more than the cost of the fee that you pay for that service. And you would see this with financial advice, like the amount of times you go, here's your portfolio of 10 ETFs. 9 of them have done really well. Let's spend the whole entire hour talking about the one that's down 10%. Like if it's legit, right? Like that happens, right? People are just like scanning through green, red. Oh my gosh, I should leave you as my financial advisor. And you're like, guys.
And this is where, those convinced against their will are of the same opinion still. Like I'm not out there to try and convince anyone to do something that they're just not in on it. But read, and that's it. If you're serious enough about, I don't want to pay fees, read the Vanguard Advisor Alpha.
Yeah, that's a good one.
Russell Investments have a report.
Yeah.
And it basically says, because there's an extra, Vanguard Advisor Alpha was like 2% over the period.
Yeah.
Paying an advisor that fee to keep the behavioral crap in check actually washed up better than a DIY.
Yeah.
And this is, and the reason I say read the Russell one as well, and I'm sure Dimension will have one, and
they probably will do.
We are into the stage now where it's categorical fact that having a portfolio solution that removes the behavior from you and your investing and the knee-jerk reaction will actually give you a better outcome. It's fact.
Definitely. Yeah.
There's an old report from the University of Berkeley. Trading is hazardous. Can't say that. Hazardous to your wealth. So the more people that trade, the less money they had. Like all this stuff's data and fact. Yeah. And if you want to say, I don't want to pay fees, will prove that you've actually done better over a 20-year period. There could be some outliers.
Oh, yeah, there would be.
And that's fine. Good for you. But most people aren't you.
Well, the other one is the Dalbar report.
Oh, yes.
Yeah,
yes.
Which has been going for 36 years now. And that effectively, like this kind of little tongue twister gets people.
Keep talking.
Yeah. This one gets people, which is that it basically says that people who are invested in the funds do worse than the funds themselves. And you think to yourself, how does an individual that's invested in a fund, say a super fund, ETF, managed fund, whatever you're invested in, how do you do worse than the fund itself? It's because of the behavior.
Yeah.
And it can be as high as like 3.5% depending on the period that you're looking at. But Dalbar's been running for decades now. And what they've shown is that on average, most people do worse than the fund that they're actually in.
Yeah.
Which is wild to think.
Well, Owen, investing works, people don't.
Yeah.
That's what we need to know. I'll put this book in the show notes. It's called The Behavior Gap by Carl Richards. I've seen Carl talk a million times live.
When you went over to the US?
No, we've flown him out to Australia many times.
Oh, right.
Like different associations and groups that I've been with.
Yeah, he's great.
But he's just got this really simple way.
He's just these charts and things.
Yeah, a little diagram. If you're watching on YouTube, they might punch in here, the greater fool theory. There's a Venn diagram, doing something dumb, hoping someone else is dumber, and then like in the middle is the greater fool. Like, it's just the older I get, the more I know my behavior is more of a detriment to my wealth building than the wealth building. So I need to get out of my own way and focus on being an entertainer, a money show guy, and outsourcing my investing.
Yeah, the other one that Vanguard, not so much Vanguard, but just over the generations, we've seen different researchers come and go and talk about this idea of the difference between security selection and portfolios. So when you think about it at a high level, there's effectively two ways that you're going to make money from investments. There's one where you pick the individual investment, so IVV versus NDQ versus IHVV versus insert something like U100 or whatever the ETF provider that you're looking at. Pick one of those ETFs, but they're all in the same bucket, which is US shares.
Yeah.
Right. So the first thing is security selection. The other thing is what's my portfolio as a whole? How much US, how much Australia, how much gold? The second decision, which is the portfolio decision, is way more influential and consequential than the individual, which ETF do I pick? Same with shares, because what it shows is that it's time in the market, not timing the market that matters. Yeah. And whether you pick IHVV or IVV or IOO, cool, important, but not as important as have you stayed invested? How much growth do you have?
Yeah, and this is in finishing, because you've probably got a life to get on with, but I don't. Democratizing investing with all these apps and platforms, like it's so good that I can log in and get invested. But there's got to be a point where it's not good to leave people to their own devices at a long term. And some people can do it. Like even if you just did VDHG, forevermore, amen. At least back to my behavioral thing, we've got a rules-based one-stop shop. It's got a little bit of property. It's got some international. It's got some Aussie. Rebalances quarterly. It's fine. I would rather someone do that than try and pick their own 5 ETFs, because I don't think most people have the stomach to do their own rules-based investing. And I think the good thing is now that you can actually build an automated portfolio on beta shares direct.
Yeah, it's cool.
I think that's best in market at the moment. But I think once you get to that point where it's like, well, I'm putting real money into a portfolio. Like I can't tell you the last time I opened my Open Invest. Is it Open Invest? Open Wealth?
Invest.
Yeah. That platform where my portfolio is housed. What's yours on?
It's actually technically run on InvestSmart.
InvestSmart, that's right. Sorry, yes. Yeah.
Yeah, so these are the underlying technology providers.
Yeah, so basically these portfolios, like if you want to log into Rask Invest, it's all Owen's IP and portfolio housed on a platform that's white labeled effectively.
Yeah, white labeled, yeah.
So it's got all the reporting and all that good stuff.
Yep. Tax reporting, yeah.
I don't know. I'm just old and I'm tired, everyone.
No, it's like, you can get, like you said, you can get great outcomes by DIYing.
But I don't manage my own investment properties either.
Well, that's what I was going to say. That's exactly the exact
I'm just not that
analogy
personality. Yeah.
Like, you can get great outcomes if you build your own house. I'm of the opinion that I want to pay a professional to do that. And there are some things that, you should DIY and you should never outsource knowledge and never outsource your own understanding because it is your money. But at the same time, you may have some sort of leverage in some other part of your life. Like if you're a doctor, you should probably just focus on saving lives and earning a really good income and just to get someone else to do some other thing. If you're a really good plumber, like we heard someone is earlier on in their career, do that. Yeah, learn about investing, be sensible, but maybe just outsource it. And they did. They chose ETFs as a mechanism for outsourcing, which is great.
Yeah.
Yeah.
Well,
we're just old, mate.
Yeah.
You know,
I'm sorry, everyone. I love it. I love people investing and all that. But what are we doing here? I want you to grow wealth. I want you to get out of your way. I want you to focus your energy on exactly what Owen said. Build a good life and career. Live on less than you earn and invest the rest.
I think you were the first person that really just hammered this point home to me many years ago, which was if your portfolio is not at $100,000, just a round figure, it could be less or more, whatever. The most important thing that's going to move your financial life forward is saving more, whether that's earning more, spending less, or a combination.
Totally.
Like shoveling more money in there will be way more consequential than
picking
is
a
it
winner.
IVV or is it, IOO? Like, that doesn't really matter.
Yeah, and that's my problem. I live in reality. The reality
That's
is
great though.
If you've got a $100,000 bank account, you save $100 a week, that's 5% of your, halve that, $50,000, saved $100 a week, that's a 10% return of your own money.
Yeah, it's great.
What are we doing here?
Yeah,
Let's go.
absolutely. Yeah.
All right, well, you can, if you're still listening, congratulations. Do you know what it is? It's because we started recording for 11 a.m. I usually don't record before 11. I'm not a morning person.
Really?
Was I a bit grumpy? Maybe I'm a bit grumpy.
It's the Melbourne weather.
It's the Melbourne weather, yeah. No. Love it, everyone. Well, you can hear Owen on the Australian Finance Podcast. Mm-hmm. And is that the best place? Do you have Instagram or?
Yeah, I'm pretty loose on Instagram. Let's go with it's ras.invest is on Instagram, our business.
Let's do that.
Yeah.
Check them out. What's the minimum to come to the party?
Kids is 5,000,
Yeah.
adults 20.
Yeah, cool.
Yeah.
And that's it. Like, there's lots of people with lots of serious money out there.
Yeah.
Pick something and get on with your life.
Yep.
Just on that kids thing, so many people just don't do it correct.
Yeah, with the tax file numbers and everything. Yeah. It's actually, well, that's because there's also conflicting statements on the ATO website. There's two different examples that give exactly the wrong case study. So, and that's why advisors are often too scared to say one way or the other either. Yeah.
My view is just build wealth in your own name, and when the time comes, gift appropriate amounts.
Put your own oxygen mask on first. And
Totally.
Yeah, you'll be able to help others.
All right, nice knowing you, everyone. We'll see you next week. Hey, if you found these episodes somewhat entertaining or useful, maybe you could send it to a friend or family member and let us know in the comments on YouTube or Spotify how you invest, what you disagree with, what you agree with. I don't care. I'm still sleeping as well tonight. Let's go. Let's have a chat. Let's have a discussion. My name is Glen James. Thanks for listening to Money, Money, Money. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorized representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.